We'll get started here. Before I introduce Tina and let her do her thing, she has a slide deck prepared. Just want to go through the normal things we go through with each with each grid meeting we've had. So, what is Grid? Grid is a global real estate community built for investors, by investors. We're not gurus. We're a group of real people doing real deals. The whole point of Grid is to find like-minded investors and find deals as well. Our mission is to connect, learn from, and collaborate with like-minded people interested in building wealth and creating impact through real estate. We welcome real estate investors of all levels. We are lifelong learners and believe everyone has value to share. What's going on with Grid? We have over 1,000 communities, 2,000 leaders. People, there's been about 10,000 people made financially free through the Grid network, and lots of millionaires. So it's more than just Grid DELCO. This spreads across the entire country. So feel free to follow them on any social media platforms. Who are we? I'm Will Holder on the William Holder real estate team. Our office is in St. David's, but we cover Delaware County, Chester County, Montgomery County, Philadelphia, the state of Delaware, the state of New Jersey. We have 12 agents on our team and 5 staff. We do about 160 real estate sales a year and about 40 rentals. And we're a part of Remax Classic. I'm also an investor. I have 63 units and I look to invest in as many boroughs as possible and do some flips. The goal of running this group and what I'm looking to accomplish is, one, help people build financial freedom through real estate and educate and give free education to real estate investors, but also partnerships. Along the way, there's opportunity for partnerships and finding deals, sharing information that can really help with both of our careers. You can connect with me through williamholderrealty.com or williamholderrealty.com or Instagram at williamholderrealty or Facebook, LinkedIn, TikTok, on every platform. And my cell phone is 610-657-6215. So before we get into it, I'll have everyone, 5 people so far, give a little bit about themselves. I'll let Tina talk about herself shortly. So how about we start with, it looks like Craig on the Zoom. Craig, you want to give a little info on who you are and everything?
Hi everyone. So Craig McFarland. I stumbled on to Grid, I believe, through Meetup. So I am, my wife and I currently work full-time in corporate America in financial services, but I'm also a single property investor looking to expand and kind of grow, learn, and network.
Awesome.
Nice. I'm Frank Barbado. I'm currently renting out a property in Philadelphia, kind of looking to expand on the rental with my fiance Allison. We live in her property now, so we're kind of looking to find a house to live in and then rent out the 2 properties that we had coming into the relationship, and that's pretty much our goal to start, and then kind of move into larger scales after that.
Awesome.
Yeah, I'm Allison. And like you said, trying to work towards a home that's a different home for us. We can rent out 2 properties, also still with that beach house. So still
on the list.
rental is still on my list. And yeah, I'm really interested today about the tax benefits and the ways you can find it in real estate.
Awesome. So
I'm Tim Aiken. I'm on Will's team, just getting into the investing and hoping to learn some stuff about the tax benefits for investors and myself.
Awesome. All right, as you guys know, we record these, so they'll be on our YouTube. Tina's going to share a lot of information. Some of it might be overwhelming, so feel free to ask questions when she's done, but you can always tap back into the YouTube video if you ever want to follow up on more information. Legal stuff, I'm going to save you with being bored with this. Just know anything we teach you here, don't hold it against us. It's free information. We're not claiming to be able to figure your life out for you. So if things don't work out, don't sue us. Okay. Release a notice. Of course, I am recording this, so it's gonna be on our YouTube page. Just give you a heads up. All right, so I'm gonna let Tina take over. Tina, I think I allowed you to share, so.
All right,
Here.
let's see here.
Yeah.
Yeah, I'm just trying to get this so where it is just my slides. Because you can see the slides on the left, correct?
Yep.
Yeah. Okay, there we go. All right, thank you, Will. I appreciate the opportunity. It's nice to meet you all virtually. My name is Tina Pashvich, and I am the Regional Sales Executive for Old Republic Exchange. We act as a qualified intermediary for 1031 exchanges, and today I'm going to go over the very basics of an exchange. We'll go over the definition, we'll go over the rules and regulations, and of course, we'll talk about the many benefits. If you are unfamiliar with a 1031 exchange and you are interested in investing in real estate, I'm about to introduce you to your new best friend. So what is a 1031 exchange? Well, it's simply the code designated by the IRS that provides a taxpayer may sell property and defer payment of any capital gains tax if that taxpayer uses the proceeds to acquire like-kind replacement property. So a couple of terms to pay attention to. First of all, the taxpayer or investor is deferring payment of their capital gains tax. And you'll see that there are substantial benefits to that tax deferment. The other term, like kind, we'll talk in a bit more detail, but essentially we are referring to any type of real property held for investment purposes. Specifically, the code states that no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, again, which is to be held either for productive use in a trade or business or for investment. Essentially, this is IRS speak for swapping one investment property for another investment property with the services of a qualified intermediary, that necessary middleman in the process of an exchange. I always like to mention that oftentimes when you hear of a real estate tax break, oh, this just must be for that wealthy real estate investor or that top 1%. Well, in fact, 1/3 of all exchanges are for properties less than $500,000, and I see many exchanges for properties less than $100,000. You can still have significant capital gain if you're selling a property for $50,000. So again, taxpayers at all levels are able to use this tax strategy. Of course, in order to qualify, the IRS has many rules and regulations, and one of the rules of the QI is to help guide you through those rules and regulations. Those rules were set forth in the 1991 Treasury regulations, like I said, issued by the IRS. Exchanges have been around for over 100 years, so it's nothing new. However, they did come down with more guidelines in 1991. Why do a 1031 exchange? Well, if you've ever looked at the capital gains tax rates, you'll see that they are fairly substantial. You're going to look at your federal capital gains tax rate, which is typically 15% or 20%, depending on your income. Then you have to add your state capital gains tax rate. Every state is different. Then, if you do not exchange, you have to tack on an additional 25% for any depreciation recapture. And depending on your income, you may have to tack on another 3.8% for the Medicare surtax. So capital gains taxes can be a shocking number at times. So rather than paying Uncle Sam, you can use your own money, in essence, reinvest those dollars into a replacement property. So either a more expensive property or multiple properties. So the idea is to leverage your own money, build up that real estate portfolio, build up, again, either the property worth or the number of properties, etc. Another benefit is allows the investor the ability to transfer to an income producing property. Perhaps an investor owns a vacant land and they're holding that's appreciating in value. That's fantastic. Well, you could exchange that for a duplex or an apartment complex, a type of property that is going to generate that rental income. It also allows the investor the ability to diversify and minimize risk to that real estate portfolio. So you can invest in residential real estate. It can be commercial real estate. So different classes of real estate. You may also invest in properties anywhere in the United States and select territories, which happen to be Guam and the US Virgin Islands. But essentially, any property in the United States is considered like-kind property. So again, those are the main reasons to utilize an exchange. And the basic concept here is that you are leveraging your own money into replacement properties. Some of the terms you'll hear me use: relinquished property, or RQ, that is the property being sold. The RP, or the replacement property, the property being acquired in the exchange. We're going to talk a little bit about the identification period. That's the 45-day period following close of the sale of the property in which the taxpayer is selling, in which you are required to provide in writing a list of potential replacement properties. We'll talk about the exchange period. That's the 180-day period following close of the sale of that relinquished property, in which you must close on the replacement property. And we'll touch upon the G6 restrictions. That is the specific section of the regulations that state when an exchanger is entitled to receive proceeds. One of the critical functions of a qualified intermediary is to hold and control the funds so that the exchanger or taxpayer does not have access to those proceeds. And we'll talk more about that a bit. What are the rules? Rule number 1, property being sold and purchased must be held for investment purposes. Primary residences do not qualify. There is the primary residence exclusion, that's section 121. If you're selling your primary residence and you are single, you can defer up to, or, not only defer, but eliminate up to $250,000 of your gain. And if you're married, filing jointly, that's up to $500,000. But again, that is not a 1031 exchange. 1031 exchanges are for investment properties only. The second rule, you must use a qualified intermediary. And again, that's what we do. You need that neutral middleman in the process to handle all of the paperwork and, most importantly, handle the funds. Number 3, the exchanger may not have actual or constructive receipt of the proceeds during the exchange period. This is critical to a successful exchange, which makes number 4 that much more critical. The exchange agreement must be entered into on or before the closing date of the property you're selling. So essentially, the exchange has to be set up prior to the property you're selling closing. Let's say I closed on an investment property. It wasn't even an in-person closing. Maybe my attorney or the title agent has the check. I've never even laid eyes on the check. And maybe the next day I, do think that I actually do want to move forward with a 1031 exchange and purchase another investment property. Well, at that point, it would be too late because I have that actual or constructive receipt of the funds, even though, again, it's not in my bank account. I certainly haven't, cashed any checks or spent the money. The fact, again, that I have access to that money would disqualify me from using a 1031 exchange. So again, critical to be aware that, again, you must have that set up with the QI prior to closing. Rule number 5, the taxpayer must identify in writing potential properties that will be the replacement property in the exchange. And again, that has to be done within 45 days of the closing of the relinquished property. And rule number 6, the taxpayer must complete the purchase of identified replacement properties within 180 days of the closing of the relinquished property. So I'm going to back up a little bit. The IRS very strict with these timelines. There are no extensions granted. And as a qualified intermediary, we are not permitted to deviate, obviously, from any of those rules. We certainly cannot backdate and will not backdate any documents. But a good QI will make you aware of your dates and send reminders of all of those timelines. But again, ultimately, it is up to that taxpayer to be aware of those timelines and abide by those timelines. I've mentioned identification a few times. There are rules of identification, proper ways to provide your identification. The first one and most popular is that 3 property rule. This is where you can identify up to 3 properties regardless of their value. And you can end up acquiring 1, 2, or all 3. Perhaps your end game is just 1 property. Well, you could still identify 3, and maybe your first option falls through for whatever reason, and you have 2 backup options. The other rule, the 200% rule, you can identify any number of properties as long as the combined fair market values do not exceed 200% or 2 times the value of the relinquished property. So keep the math easy. If I'm selling a property for $100,000, I can identify any number of properties as long as those combined values do not exceed $200,000. It's very critical to a successful exchange, again, is this 45-day identification timeline. We send identification documents. We ask you to select a rule, and you simply write down the written addresses of possible replacement properties. There is the 95% exception. If you were to not select a rule and simply write addresses down, the only way that would be valid would be if you closed on 95% of the value of all the identified properties listed. So this is prone to failure because it's simply too aggressive. Imagine if you've identified 8 properties, you'd have to be pretty sure that you could close on all 8 of those properties. So again, when you utilize an exchange, if you're selling 1 property or 2 properties, you can identify more than 1 property. You can also, on the other end, like I said, sell 2 properties, buy 1 property, sell 1 property, buy multiple properties, but again, within these rules of identification. So let's take a look at that delayed exchange timeline. At 0 days, I have close of the first relinquished property. If you are combining more than 1 property into an exchange, you can do that, but the timeline starts ticking at the close of that first property. You then have that 45-day window to provide that written identification of possible replacement properties, and then a total of 180 days to close. And if you're purchasing more than 1 property, you can do so, but all of the properties must close within that 180-day window. And as you can see, it's not 45 days plus 180 days. That exchange period is in its entirety 180 days. Very strict. Again, 45th day ends at midnight on the 45th day. So if you are closing on September 12th, that calculation begins the very next day. Same with that 180th day. If your 180th day happens to fall on a weekend or holiday, you have to be aware of that and close prior to that. I've heard many a sob story about, a holiday or a weekend and not thinking that, or thinking that only business days counted. But again, these are calendar days. There are 4 methods of exchange. The first and most commonly used is your standard delayed exchange. That's where you're selling your relinquished property, and then you close on your replacement property within 180 days. There's the simultaneous. That's where the closings happen on the same day. You can certainly do that, but that property that you're selling has to technically close first, and then the property you purchase. With a delayed or simultaneous exchange, the contracts are simply assigned to the qualified intermediary. An example of a fee for a delayed or simultaneous exchange will run you about $1,500 to $2,200. And I say that to provide contrast to the next two types of exchanges, and that is the reverse exchange and the improvement exchange. The reverse exchange is, as it says, or as it seems, it's just in reverse order. So you purchase that replacement property before you close your relinquished property. Well, this is a good option if the exchanger has identified a replacement property they don't want to miss out on it, and their relinquished property hasn't sold. Or perhaps they're obligated, they're under agreement to purchase that replacement property. In this case, the qualified intermediary jumps in and holds title to one of the properties in the exchange. So it's a much more complex type of exchange and much more expensive. Reverse exchanges start at $8,500. So that's a pretty hefty fee, and that's across the board with all QIs. But having said that, if you look at your capital gains tax ramifications, it still may very much be worthwhile. Then the other type of exchange is your construction or improvement exchange. This is where you are selling that relinquished property. You use that exchange accommodation title holder. So that's essentially the QI jumping in and holding title to the replacement property while proceeds are used to construct improvements. And then when those improvements are completed, the replacement property is conveyed back to the exchanger. This is a good time to talk about the equal or greater concept in an exchange. In order to defer 100% of your capital gains tax, you want to reinvest all of your proceeds into a property equal or greater in value to the property that you're selling. So again, if I'm selling a property for $100,000 and using an exchange, if I wish to defer all of my tax, I want to purchase a property or properties that are at least $100,000 or more. Now, let's say I find a property I love for $80,000 and I don't wish to purchase additional replacement property. I can do that. That is a partial exchange, but you will be required to pay tax on that difference. In a construction or improvement exchange, let's say you're selling a relinquished property for $500,000. and you find a property for $250,000 that needs capital improvements. Well, you have that extra $250,000 that you need to make up. So you could use those towards identified improvements, but only under the construct of an improvement exchange. Improvement exchanges, again, the QI is holding title to the property and they are $9,500. So again, a great contrast. So the first two contracts are assigned to the qualified intermediary. The reverse in construction, the qualified intermediary is actually holding title to the property. What qualifies as like kind? Well, this is a very broad and liberal term, essentially any type of real property held for investment. So this could be a single family home, as long as it's not your primary residence. You could exchange that for multifamily. You could exchange vacant land for a strip mall, or perhaps you want to change your line of business and exchange a hotel for a farm. So the physical characteristics do not need to be identical. You do not need to exchange a duplex for a duplex or residential for residential. And again, anywhere in the United States is considered like kind. So again, if you want to change, maybe relocate your business from Pennsylvania to Florida, you can do so with the 1031 exchange. So let's talk about property excluded from 1031 exchanges. Any stock in trade or other property held primarily for sale. This is where flips come into play. Flips typically do not qualify for 1031 exchange tax treatment because the idea is to get in there, fix it up quickly, and get it out on the market. So again, the intent is to hold primarily for sale. Investment properties for 1031 exchanges, the intent must be to hold primarily for investment purposes. So the IRS does not literally say you need to hold a property for 1 to 2 years, but most tax practitioners will advise a 1 year, 1 day hold period at minimum to qualify as an investment property. Any bonds or notes do not qualify. If the seller is providing any money to the buyer in the form of a note, that note must be written in a certain way with the QI's name and be paid off in that exchange period. Anything paid outside of that exchange period would be taxable. Any other securities or evidences of indebtedness or interest, any interest in a partnership. Partnerships can exchange, so ABC Corporation can exchange, but there are problems when certain partners wish to go off their merry way. Maybe they want to sell and not invest into another replacement property. So again, A cannot just simply cash out and go on their merry way. There are strategies you can use when you drop out into a tenants in common interest, but you want to definitely talk with your tax advisor before you do that. Any certificates of trust or beneficial interest, if there's any sort of action on your property, that would not qualify. And personal property doesn't qualify. With the latest tax changes in 2017, the personal property was stopped, canceled essentially. Back in the day, you could exchange farm equipment, for example, or an airplane that you used for work. But now, after 2017, exchanges are for real property only. Let's quickly talk about potential hazards in an exchange. Vesting. Vesting is critical, again, to a successful exchange. Whoever is on title to the property being sold in an exchange must be how title is acquired in the replacement property. So if Joe Smith owns the property being sold, Joe Smith is the only one that can be entitled to the property that is being acquired. Issues happen. Let's say Joe Smith was single when he acquired the property he's selling. He's now married, wants to add his wife to title. Well, if he does that, the IRS could look at that, or would look at that, as a 50% gift. So anytime we set up an exchange, we require a copy of the vesting deed or title commitment to set you up for a successful exchange. Now, if you do own a property and you want to purchase a property with a co-investor, you can do that in a tenants in common relationship. You could go in 50-50, for example, with a partner. Partnership interest, I mentioned before, partnerships can exchange, multi-member LLCs can exchange. However, if a member wants to drop out, you need to drop out soon or far in advance of an exchange as possible, and talk to your CPA. But again, you have to be careful with that. Talked about any carryback financing, any notes in the exchange. Repair work. Repair work is not considered an allowable expense, so you want to bring out-of-pocket money for that. Related parties. What happens if I want to purchase an investment property from my mother? Well, the IRS enacted related party rules. If I were to purchase that property from my mother, I could do so, but I'm going to have to hold on to that property for a minimum of 2 years, and my mother will have to use an exchange and hold on to her respected party for a property for a minimum of 2 years. And that is because the IRS enacted these rules so related parties would not basis shift or sell a property for less than it's worth to avoid paying taxes. So if you do exchange with a related party, you have to be aware of those highly scrutinized related party rules. Any non-exchange related costs, prorated rents, for example. And then this pesky holding requirement, how long do I need to own a property for it to be considered an investment property? Again, most CPAs, tax practitioners recommend a 1 year, 1 day holding period. Sometimes if it's a vacation home and there's limited personal use, you're going to want to hold on to that property for a minimum of 2 years. The benefits of a 1031 exchange, first and foremost, you're deferring capital gains tax. That can sometimes be upwards of 25, 30, 35%. it can take a huge chunk out of your profit and can be a shocking number. So again, use your own money in essence, leverage that money for wealth building. So you can purchase multiple properties, keep building up that real estate portfolio, and in essence, build real estate wealth. It allows you the ability to relocate your assets, like I mentioned before, into different classes of real estate, and also geographically anywhere in the United States. And another excellent benefit is the estate tax planning tool. There's no limitation to the number of times you can utilize an exchange. And I'll use my mother as an example again. Let's say she has an investment property, passes away, and I'm the heir to that property. Well, I will receive that on what is referred to as a stepped up basis. So if I sell right away, I will not have to pay any capital gains tax. If I hold on to that property for 5 years and then sell it, I will only be on the hook for the taxes for that 5 years. So again, it's a great strategy, a great estate tax planning tool. And I hate to say the only way to avoid paying capital gains taxes altogether is, unfortunately, to pass away. But again, if you are thinking about your estate planning, there is no limit to the number of times you can exchange, and your heirs receive it on a stepped up basis. So what does a qualified intermediary do? Well, it is required by the Treasury that you utilize this neutral middleman in the exchange. So we acquire the relinquished property from the exchanger, and we transfer it to the buyer. And same with that replacement property. We prepare all the documents. This includes the exchange agreement and the assignment for the sales contract for both the relinquished and replacement properties. We consult with the exchanger's tax advisor if requested. It is important to note that we are not permitted to give tax advice. We always recommend a consultation with your tax advisor. And your first step is always to figure out what your capital gains tax ramification would look like if you were to just go ahead and sell and pay taxes. We execute the closing documents as principal, so as the seller in the RQ closing and as the buyer in that RP closing. Critical function, we hold the exchange proceeds to prevent the exchanger from actual or constructive receipt of the funds, and we coordinate with closing agents, real estate agents, tax and legal advisors. You want to do your due diligence when selecting an intermediary. There are a handful of really good companies out there, but there are many more not so reputable companies out there. So the last thing you want to do is a Google search. Do your due diligence, look for a reputable company, obviously in compliance with the code, a financially secure company, and an experienced company. Old Republic Exchange, for example, is a subsidiary of Old Republic International. So this slide is a bit outdated. It's close to a $22 billion industry. Old Republic Exchange has a $50 million errors and omissions policy and a $120 million fidelity bond. So you definitely want to make sure the QI has insurance and that they can prove it. And again, typically look for a company tied to a larger title company or a larger bank so that you can assure that your money is safe and secure. My contact information, feel free to reach out anytime, email or call. We have an excellent website, oldrepublicexchange.com. There is a handy do the math calculator. So if you want to punch in some numbers to see what an exchange savings might look like. We also have an excellent library of articles if you want more information on a reverse exchange or partnership transactions. Take a look at that. And there's also a few handy videos as well. So again, for real estate investors, a majority of wealthy people in the world are wealthy because of real estate. And definitely, like I said, their best friend is the handy 1031 exchange. So it's very good information to have. And again, taxpayers at all levels use this strategy. So, if you're selling your first property and it's $75,000, again, you could still have significant capital gains. So touch base with your accountant and see if an exchange is worthwhile for you. So that's it. Does anyone have any questions?
Awesome. Yeah, Tina, that was great. We do have a couple questions, and
Okay.
Craig, I'll start with the first one. He asked, what is the outcome of violating the timeline?
It would be a failed exchange. So if, for example, you do not provide written identification that in that 45-day window, it would be a failed exchange. If you have identified property, but you fail to close on identified property, it's a failed exchange. So there's no harm in setting up an exchange, but if you fail to, find property or close, you're not penalized by the IRS. You've given it, a fair shot. It's just deemed a failed exchange. You're out the qualified intermediaries fees, and of course, then you end up paying your capital gains tax.
Okay. And he also asked, are capital gains tax implications if the properties are bought and sold under a trust or an LLC?
Yes, absolutely. Yeah. Doesn't matter how you hold title, the capital gain, as soon as you sell it, you'll be on the hook for capital gains taxes. But you can use an exchange if you hold property under a trust or an LLC. Again, if it's a multi-member LLC, you just want to make sure that the entire LLC sells and that entire LLC acquires the replacement property.
Excellent. Anyone have any questions outside of that? Great. Awesome. Well, thank you so much for your time this evening, Tina. We really appreciate it. And I'll get this information. I'll get this video over to you.
Thank you. I appreciate the opportunity. Thank you so much.
Thank you.
Okay, so now I'm going to jump into my slides. Here. Alrighty. Okay, so Tina went into the she went over the 1031 exchanges. Again, her company, it's all they do, very legitimate. If you're ever looking to do one of those, I highly recommend them. I've recommended them to a bunch of clients. They've had great success. I recently had a client who was a friend sell his property that was in an LLC, and then we combined our LLC and his LLC to purchase a property. So he was able to defer those capital gains to purchase the property as a 50-50 partner with our LLC. So you can do all sorts of creative things and, level up. He went from a row home in Camden to an 11-unit building because he combined and deferred the taxes. So there's plenty of ways to do this. And you could keep doing that over and over and over again until eventually it ends up in a trust or an estate, and you continue to defer the taxes to make life easier for your heirs. So the next option is a self-directed IRA. What is a self-directed IRA? A self-directed IRA allows you to hold alternative investments in a retirement account. Unlike traditional IRAs or Roth IRAs, which often consist of stocks and bonds, a self-directed IRA provides a broader selection of investment options like real estate. You can invest your IRA money into real estate, notes, businesses, stocks, bonds, gold, etc. But you need a qualified self-directed IRA custodian. So I don't know if you see a trend here. If you're going to do it, you got to have somebody that's qualified to help you do it, right? The IRS does not trust that we're going to do this correctly or legally. So they have people in the middle, companies that do it, that are insured, that are professionals, so that you don't get in trouble for doing it, hiding too much, right? Getting started, open and fund a self-directed IRA account. So mean, you guys know what the benefits of an IRA are, right? It's tax deferred money. You're putting money in there. You don't have to get taxed on that. You can then leverage that as a loan to yourself, essentially, to invest, right? That's the point of a self-directed IRA. So, you know, but you need a qualified custodian. And these are a lot more common. A lot of banks, credit unions, they have investment companies that you can work through to set up a self-directed IRA.
William, a quick question. Sorry to interrupt.
Sure. Yep.
Is the content available to be shared? I'm not sure if you intended to share it while speaking.
Oh, the screen's not shared?
No, thank you.
Thanks for pointing that out. I thought this was shared. There we go. Can you see that, Craig?
Thank you. Yes.
Perfect. Perfect. And then obviously step 2 is find a property to purchase. Step 3, direct your custodian to fund your investment with your account. Provide your custodian with the specifics of the property you'd like to purchase with your IRA, how much money you need, where to send funds, and if documentation requires signing. You can choose to fund the entire purchase or a portion of it with your account. So you don't have to buy the entire property with your self-directed IRA. You can use it as your down payment, right? On your loan. Manage the investment in your account. Money from the expenses and profits must flow to and from your account in the same proration that it funded the investment. So again, they want everything flowing through this so there can be a paper trail. All right. It's all about how they can track it. There are rules you need to follow when using your IRA for real estate, but they're not complicated. Basic concept: real estate owned in your IRA must be purely for investment purposes. Again, I don't want you doing this on your primary residence. This is for investments, right? All expenses of the property must be paid through the IRA, not by you directly. Okay, so run it all through the IRA. Again, it's all about the paper trail. You can't use furniture you currently own in an IRA owned rental property. So, you know, it's good to know. Any income generated by real estate held in your self-directed IRA must be paid and returned to the IRA, not to you. You cannot use your self-directed IRA to buy property from yourself or a family member. So, again, they put these rules in place so we don't get too creative with how we're selling property within our family or ourselves. And then final thoughts: if you ever wanted to invest in a real estate project, you can lend developers money from your self-directed IRA as long as you set up a self-directed IRA or choose a qualified custodian. You can raise cash from other people that have self-directed IRAs to help fund your deals. There are so many possibilities, and knowing how to use these tools can add rocket fuel to your retirement accounts. And this is super common. A lot of private lenders are using their self-directed IRAs. Whenever I go to other meetups, I meet with private investors as well that have a self-directed IRA. They want to be the lender. They don't want to be they've done the investor part, right? And there's levels to investing. When you get to the point that you're the lender, it actually gets a lot easier because people are bringing deals to you. So you're not doing all of the legwork to find the deal, negotiate it, get it under contract, get the contractor set up, all of that, get the lender. When you're the lender, people are bringing you that package and you're deciding if you're lending to them or not. And if it's from your self-directed IRA, you get the full decision and you can put a lien on their property. So it's a secured investment. And they're paying you back a pretty high percentage. You know, most regular mortgages right now they're low right now. They're 7%. They were 8.5% a couple of weeks ago. They're low right now, but if you're borrowing from someone that's using a self-directed IRA, you're probably paying them 10 to 15% right now. So the return on these things could be great. So you don't have to use it just for your own purpose. You can find people that have a self-directed IRA set up to help you invest, right? And you can structure these deals however you want to structure them. If you want to use a regular hard money lender or a bank, commercial bank, to fund the 80% of your purchase and 100% of your renovation, and then use a self-directed lender to fund your down payment and your closing costs and your holding costs, you can do that. You know, that's why people wonder how people scale so quickly. It's usually just because they're using creative ways to fund deals. They're not using all their own capital. And if you can avoid using all your own capital, that's the best way to go, because you're now taking less risk while leveraging other people's money, right? So these are great products. Combining 1031 exchanges with other strategies like cost segregation and self-directed IRAs on your income properties, and you can squeeze additional millions out of your portfolio over a lifetime. When you think about it, if you were to buy a property, sell it, buy another, sell it, buy another, and you're paying 35% taxes on those capital gains every time you sold it, and you expand that over your entire lifetime as an investor, you're talking about millions of dollars you're paying in taxes over that lifetime. Whereas if you use these tools the IRS provides to you, you keep that money, you keep it in your portfolio, and you're able to scale faster, right? So definitely use these. This is how the rich get richer. There's no, it's not that secret. This is what everyone's doing. They're, borrowing against the tools or deferring the taxes, right? Right. So that is the presentation for today. Any questions?
Is there a limit on the self-directed IRA? Like, I'm trying to think, like, traditional, you can only put in, like, what is it now, 22 a year?
Oh, yeah,
That-
yeah.
Like, is there a limit on that?
Honestly, I'm not sure.
Okay.
Yeah, I think that's a question you have to ask an intermediary, but I couldn't tell you yes or no on that. I could get you the answer though. I will. I know someone I'll call. But I don't know, and I'll get you that answer though.
Okay.
Yeah. Anything else, Craig? You got anything?
No, I was kind of just thinking through, for many individual investors who already have retirement accounts, including, their own IRA. The one you're referencing, it should be exclusively for the use of real estate investing, correct?
No, you can use it to invest in other types of things too. You can use it to invest in notes, businesses, stocks, bonds, gold. Like it's not just for real estate. It's for other types of investments, similar to the 1031. The big key is just using a qualified self-directed IRA custodian.
Thank you.
Yep. Awesome. All right. Well, I'm gonna shut the Zoom down. This will all be saved, and we'll have it on our YouTube page. I appreciate you guys coming. And have a great night.